Hi everyone, welcome to this week's CLiK Trading Education market breakdown for the week ending 17th of April. This was a strong week across equities, crypto and metals, but more importantly, it was a macro-driven move, not just technical. So in this video, I'm going to break down what actually moved the markets, why it moved, and most importantly, what it means for your trading going into next week. Because as always, we're not here to chase moves, we're here to understand them. This week wasn't just a rally, it was driven by four key macro forces: rate expectations shifting, reduced geopolitical tension, a major repricing in energy, and continued AI-driven optimism. But here's the key point. Our job is not to trade the narrative, it's to understand how it affects location, probability, and risk. Equities had a strong week across the board, Nasdaq leading, Russell catching up, and the Dow participating as well. What's driving that? Liquidity expectations. Markets are now pricing in less aggressive tightening, more stable inflation, and the possibility of future easing. That combination supports equities, especially growth. But from a trading perspective, price is now extended from demand and approaching higher timeframe supply. Strong trend does not equal good trade location. This is where things get interesting. Gold and silver both pushed higher, which makes sense. Lower rate expectations, softer dollar, continued hedging demand. But the standout move, crude oil down nearly 20% in a single week. That's not noise, that's a repricing. What this tells us is markets are pricing in lower inflation, but still stable growth. That's a powerful combination for equities, but it doesn't tend to last forever. Crypto moved strongly again this week. Bitcoin, Ethereum, and the broader market all pushing higher. But this is not about fundamentals. This is liquidity and sentiment. When rate expectations ease, confidence returns and volatility drops. Crypto tends to move aggressively, but here's the problem for traders. Strong trend, but very poor entry location. Limited pullbacks means higher risk, lower reward, so the focus stays the same. Wait for price to come back to demand. Don't chase the strength. Forex this week was not clean, and that's important. We saw dollar weakness against euro, pound, Aussie dollar, but strength against JPY. That tells us one thing. This is not a USD trend. It's a divergent story. Different central banks, different expectations, different outcomes. So from a trading perspective, drop the bias. Focus on individual pairs, clean structure, clear supply and demand levels. Now this is the part most traders ignore. The VIX dropped over 17% this week. That tells us markets are comfortable, risk is being underpriced, and participation is increasing. And historically, that's where mistakes start to happen, because low volatility feels safe, but it usually comes just before sharper moves. Single stocks were driven heavily by one thing: the AI narrative, Tesla, Microsoft, Nvidia, Palantir, all pushing higher. Capital is flowing into growth and innovation. But here's the reality check. Narratives extend moves. They don't improve trade quality. So if you're buying here, you're likely buying after the move, not before it. So when you step back, this week wasn't random. It was driven by five key forces: monetary policy expectations, reduced geopolitical risk, energy repricing, tech narrative, and liquidity-driven participation. And when all of those align, you get broad risk-on behavior across markets. Now, here's what actually matters for you as a trader. Yes, markets are strong, sentiment is positive, liquidity is supportive. But structurally, we have a problem. Markets are extended from demand, risk to reward is deteriorating, and emotional participation is increasing. This is where discipline matters. Patience is not inactivity, and it's actually an edge. Two questions for you this week. Are you reacting to headlines or following a plan? Are you buying at wholesale or paying retail? Because right now, most traders are paying retail, and that's exactly where professionals are looking to do the opposite. Remember this: price moves because of supply and demand imbalances, not because of news. News explains the move. But the opportunity comes from location. And right now, extension is risk, not opportunity. Just a quick reminder, all trading involves risk. This content is for educational purposes only and not financial advice. Always trade with a structured plan and controlled risk. So going into next week, we're not looking to chase markets. We're looking for price to come back to us, because that's where the real opportunities sit. If you want to take this further, the next step is mapping these markets into higher time frame supply and demand zones. That's where this becomes actionable. Thanks for taking the time to watch. And if you found this useful, give it a like, share it with someone who's on the same journey, and subscribe for more structured market breakdowns like this. Have a great week and trade well.